Hey everyone, welcome to the deep dive. Today we're diving into something that's like super important for any investor. It's the PE ratio, and I'm really excited to talk about it today.
Yeah, the PE ratio, it's one of those things that can seem a little intimidating at first, but once you grasp it, it can be a really powerful tool in your investor's toolbox.
I totally agree, and we have some great sources to help us break it down. So, the goal is to help you guys understand this metric and how you can use it to like potentially improve your portfolio. Maybe find some hidden gems or avoid some potential pitfalls.
Yeah, and I think the sources you found do a great job of laying out the basics, but also getting into some more like nuanced examples, so we can really see how this plays out in the real world.
Perfect. So let's just start with like the most basic question. What is a PE ratio?
Okay. So in simple terms, the PE ratio, it stands for price to earnings ratio. Basically, it tells you how much you are paying for each dollar of a company's earnings.
Right. So is it kind of like if a company is trading at $100 per share and it earns, let's say, $10 per share, the PE would be 10.
Exactly. You got it. That means investors are paying $10 for every dollar of profit the company makes.
Okay. That makes sense. So is there like a good analogy to help people understand that? Because it still sounds a little abstract to me.
Sure. Think of it like buying a business outright. Imagine there's like a lemonade stand that's making $1,000 in profit every year, and you decide, hey, I want to buy this lemonade stand. If you pay $10,000 for it, you've essentially paid a PE of 10. You're paying 10 times the annual profit.
Okay. Now that makes a lot more sense. I can see how that would help.
hmm
Now I was looking at the sources and I noticed there are different types of PE ratios like forward PE and trailing PE. Could you explain those?
Absolutely. So trailing PE is what we were just talking about. Using the past 12 months of earnings. It's basically looking in the rearview mirror, at the company's actual historical performance.
Okay, so it's based on hard data, what they've already earned.
Exactly. Like one of the sources gave the example of FedEx. Back on February 9th, 2024, their trailing PE was 14.50. And they got that number by taking their stock price at the time, which was $242.62, and dividing it by their earnings per share over the last 12 months, which was $16.85.
Got it. So what about forward PE? Is it like a crystal ball trying to see into the future?
Well, it's kind of like that. Forward PE uses projections of future earnings. So instead of the past, it's looking ahead, trying to estimate what the company might earn in the coming year.
Okay, but that seems a lot more uncertain, right? You never know for sure what's going to happen in the future.
You're right. That's a key limitation of forward PE. It's based on estimates that can be influenced by a whole bunch of factors, market conditions, competition, all sorts of things.
So basically, we need to take forward PE with a grain of salt. It's more about getting a sense of investor sentiment and maybe potential growth, not a guaranteed picture of the company's value.
Exactly. It's like a possibility, not a promise.
Right, right. So we've got a good grasp now on what PE is and these different types, but like how can we actually use this information, this ratio, to like make better decisions about our own portfolios?
That's the million-dollar question, right? Well, one thing to keep in mind is that the PE ratio is most useful when you're comparing companies within the same industry.
Oh, that makes sense. Why is that?
Because, different industries have different norms and expectations for growth. Comparing a high-growth tech startup to a utility company wouldn't really tell you much. They operate in totally different worlds.
So we're looking for apples to apples comparisons.
Exactly. You want to compare companies that are playing in the same field, so to speak.
Okay, so let's say we're looking at two companies in the same sector. How can their PE ratios help us decide which one might be a better investment?
One of our sources had this really cool example. They looked at two energy companies, Hess Corporation, HES, and Marathon Petroleum Corporation, MPC. And this was back on February 9th, 2024.
Okay, so what did they find?
Well, HES had a PD of 31.64, while MPC's was only 7.19. That's a huge difference. So it immediately makes you think, okay, what's going on here?
Yeah, like is HES just way overpriced compared to MPC?
Not necessarily. A high PE doesn't always mean a stock is overvalued. It could mean that investors have really high expectations for HES's future growth. Maybe they think HES is going to make some big discovery, or they have some secret weapon that's going to give them a competitive edge.
So it's almost like a vote of confidence from the market.
In a way, yeah. A high PE can reflect optimism, while a lower one could signal that the market is either undervaluing the company or has some concerns about its future
So
prospects.
it's like reading between the lines, trying to understand the story that the numbers are telling us.
Exactly. The PE ratio is just the starting point. It gives us clues, but we need to dig deeper to really understand what's driving that number.
Okay, this is all starting to make sense, but I think we need to take a break and come back and look at some more examples to really solidify this.
All right, so, we were just talking about HES and MPC. Those two energy companies with like really different PE ratios.
Yeah, that was super interesting. Like, what can we learn from a situation like that?
Yeah.
I mean, should we just assume that HES is like, overvalued because its PE is so much higher?
Not so fast. You see, a high PE, it doesn't always mean a stock is overpriced. It could be that investors are seeing something, some potential that justifies that higher price tag.
Okay, so like what kind of things might they be seeing?
Well, it could be a lot of things. Maybe they believe that HES is on the verge of like a major discovery, a new oil field or some like breakthrough in renewable energy technology, something that's going to like supercharge their earnings.
Right, so they're basically betting on the future. They're saying, hey, even though HES is expensive now, we think they're going to be worth even more down the road.
Exactly. Or maybe investors are impressed with HES's management team. They've got a track record of success, or maybe they've got some strategic advantage in a particular market. There's a lot of possibilities.
So it's like we got to put on our detective hats and really dig into the company's financials, understand their debt levels, analyze the industry trends, look at the overall economic outlook.
You got it. It's about connecting the dots, seeing if the narrative, like, supports the valuation. And, another interesting example from the sources was FedEx.
Oh, yeah, I remember. Their trailing PE back in February was 14.40. But like, how does that compare to like the broader market?
Good question. So at that time, the S&P 500, it had a PE of around 22.
Oh, wow. So FedEx was actually trading at a lower PE than the market average.
Yep.
Does that automatically mean it was undervalued? Like a bargain?
Not necessarily. Remember, we always need context. We have to look at FedEx's specific industry. They're in logistics and shipping.
Huh?
So the question is, how does their PE compare to their competitors, companies like UPS or DHL?
I see. So if their PE is way lower than their peers,
Mhm.
it might signal that, the market's overlooking them. But if it's in line or even higher, then maybe the market has already factored in their potential.
Exactly. And this brings up another point. The market, it's not always right. Sometimes a stock with a low PE, it really is a hidden gem, a value play. And then other times, a stock with a high PE keeps going up because its growth just keeps exceeding expectations.
It's like trying to predict the weather.
Yeah.
Sometimes you get it right, sometimes you get rained on.
Yeah, there's always an element of uncertainty, but the key is to do your homework, understand the company, the industry, and then use the PE ratio as one piece of the puzzle.
Right. It's a clue, not the whole answer.
Exactly. Now, I know a lot of people are probably wondering, like, okay, all this is interesting, but how do I actually use this in my own portfolio?
Yeah, like how do I take this knowledge and turn it into better investment decisions?
Well, one thing you can do is look at historical PE ranges for the companies you're interested in. Go back 5 or 10 years and see how the market has valued them over time.
So if a company's PE is currently like way below its historical average, it might be a sign that the market's undervaluing them. Or if it's way above, it might be a warning sign. Like, is this justified? Is something else going on?
Yeah, you're looking for those outliers, those stocks that might be out of whack with their normal range. Could be a buying opportunity, or it could be a sign of trouble.
So we're looking for patterns, trying to spot those trends.
Right. And another good strategy is to compare the company's PE to the industry average. This gives you a sense of whether they're trading at a premium or a discount to their peers.
So if an entire industry has high PE ratios, it might not be that concerning for an individual company. It's just part of the overall trend.
Right. It's all about context. You got to ask yourself, is this company out of line with its peers, or is the whole sector just hot right now?
Okay, that makes sense.
Yeah.
But, beyond just comparing numbers, we also need to like understand what's actually driving those PE ratios. Is it real earnings growth? Is it a strong market position? Or is it just hype and speculation?
Yeah, that's the crucial question. You got to look under the hood and see what's really going on. Is this company building a sustainable business, or is it just a flash in the pan?
It's like buying a used car.
Yeah.
You can look at the mileage and the paint job, but you
Yeah.
got to take it for a test drive and make sure the engine's not going to fall out.
Exactly. And that's where our analytical skills come in. The PE ratio, it's a valuable tool, but it's up to us to do the due diligence. We have to understand the company, the industry, and then make our own judgment call.
And even then, there are no guarantees, right? I mean, the market can be unpredictable.
Oh, absolutely. That's why it's so important to diversify. Don't put all your eggs in one basket, even if the PE looks amazing. Spread your investments across different companies, different sectors, different asset classes.
Right. Don't fall in love with just one stock.
Exactly, because even the best companies can stumble. And a diversified portfolio helps you ride out those ups and downs. So, the bottom line is the PE ratio, it's a powerful tool, but it's only one piece of the puzzle. We need to use it in conjunction with other metrics, other information, to really get a complete picture.
Right. It's about taking a holistic approach, not getting tunnel vision on just one number.
Absolutely. Investing is about more than just crunching numbers. It's about understanding the story behind those numbers, and that's where the real insights come from.
Speaking of insights, we talked about some other valuation methods earlier. Could you remind our listeners what those were?
Sure. So besides the PE ratio, there's also the price to book ratio, the price to sales ratio, and the enterprise value to EBITDA ratio.
And each of those gives us a slightly different perspective on the company, right?
Exactly. They look at different aspects of the financials. So by using a combination of these metrics, we can get a more well-rounded view of the company's value.
Okay, that makes sense. And remember, guys, there's a ton of information out there. Don't be afraid to do your research. Read books, listen to podcasts, talk to financial advisors.
Yeah, knowledge is power. The more you learn, the more confident you'll become as an investor.
Absolutely. And, investing should be a lifelong journey of learning and discovery.
I couldn't agree more. The market is constantly changing, so we need to constantly be learning and adapting.
So we've been talking about PE ratios for a while now,
hmm
and I think, we've covered a lot of ground.
Yeah, we've gone from the basics to some pretty in-depth stuff. Hopefully our listeners are feeling like they've got a good grasp on this whole PE thing.
Yeah, I think so. But, I'm wondering if there's anything we haven't touched on yet, like any kind of, I don't know, advanced concepts or nuances related to PE that we could, dive into.
There are actually, one thing that comes to mind is the idea of absolute versus relative PE ratios. Have you heard of that?
I've heard the terms, but I'm not sure I totally understand the distinction.
Okay, so absolute PE is basically what we've been talking about this whole time. It's just, the current stock price divided by the earnings per share. It gives you a snapshot of the company's valuation right now.
Okay, so that's the number we see when we look up a stock quote.
Exactly. But relative PE, that's where things get a little more interesting, is when you compare the current PE to some kind of benchmark, like the company's own historical PE range, or maybe the overall market PE.
I see. So it's putting the current PE into perspective.
Exactly. So let's say a company has a PE of 20 right now. To know if that's high or low, we might look back and see what their average PE has been over the past 5 years or 10 years.
Right. So if their current PE is much higher than their historical average, it could mean investors are more optimistic about them now than they were in the past.
Or it could mean their earnings have dipped recently, but the market expects them to rebound. It's all about interpreting the signals.
What about if their PE is lower than their historical average?
Well, that could mean the market's less confident in their future. Or it could be that their earnings have been growing steadily, but the market hasn't fully caught up yet.
So relative PE helps us see if a stock is out of sync with its own history or with the broader market.
Right. It's another tool in the toolbox, helps you spot potential opportunities or red flags.
Okay, that makes sense. Are there any other advanced PE concepts we should know about?
Yeah, one more I'd mention is the PEG ratio. Stands for price earnings to growth.
Ah, yeah, the PEG ratio. I've heard that one thrown around. It seems like growth investors really like that one.
They do. It basically takes the PE ratio and factors in the company's expected earnings growth rate.
So it's like adjusting for future potential, not just
Sure.
current performance.
Right. A company with a high PE but really high expected growth, they might actually have a low PEG ratio.
Because even though the price is high relative to their earnings now, those earnings are projected to grow a lot, so maybe the high PE is justified.
That's the thinking behind the PEG ratio. It tries to account for that future growth trajectory.
So once again, it's don't rely on just one number. Use multiple metrics to get the full picture.
Absolutely. That's the key takeaway here. The more tools you have, the better decisions you can make.
Well, I think this has been a really insightful deep dive into the PE ratio. We've covered a lot of ground, and I hope our listeners are feeling more equipped to use this in their own investing.
Me too. The PE ratio, it can be a really valuable tool, but it's important to use it wisely, in context and always do your own research.
And remember, investing is a journey. It's about constantly learning and adapting. There's always something new to discover.
Absolutely. Stay curious, keep learning, and never stop asking questions.
And speaking of questions, we always love hearing from you guys. So if you have any topics you want us to deep dive into or specific stocks you'd like us to analyze, head over to our YouTube channel and leave a comment.
Yeah, we really appreciate your feedback. It helps us make the show better and more relevant to what you guys are interested in.
Thanks for joining us on the deep dive. We'll see you next time.
Happy investing, everyone!